Starbucks is one of the most undervalued companies to buy now. It is trading near its 52-week low, and as we can see, a forward yield of nearly 3% and a buy rating from Wall Street. So today's episode, we're going to do an updated look with new numbers for this company. We're also going to take a quick look at their earnings, just run through a few key points that you need to be aware of. And as always, we're going to look at both insiders, their buys as well as their sells. We'll get an updated look of what the institutions are doing in the more recent quarter. We'll also talk about the dividend safety score. Now, this was downgraded to a borderline safe score, so we'll understand whether or not there is any worry with them being able to pay this yield nearly at that 3%. And we'll also get a look at their top line revenue as well as their bottom line net income year-on-year movement, as well as their health of the company, the updated numbers from their quarterly report, their total cash versus their total debt. As always, we are going to run it through the valuation model with our updated intrinsic value, the acceptable buy price factoring in our margin of safety, and we'll look to see what Wall Street are forecasting for Starbucks over the next 12 months to get the percentage upside. So let's just remind ourselves of the historical performance of this company. Now, we can see over the last year, they are down around 26.34%. Not great at all. They have been hammered, but we can see just over the last week, it has started to pick up slightly, up 2.38%. Now, if you've been a shareholder over the longer term, the last 10 years, you would be up 116%. You'd be up slightly higher if you were reinvesting those dividends. And we also note that all-time highs, July 2021, $126. So it is some way away from that figure. So let's just get a quick look at their earnings that did take place just a few weeks ago. And the main thing to note from here that I do want to draw your attention to is that their top line comparable revenue in every sector is in fact down. We can see their global revenue down 4%, North America down 3%, international down 6%, with China being double digits, negative 11%. Now, in terms of their revenue as a whole from the same quarter last year, they are down 1%, which isn't really a great sign for a company like Starbucks, where you would be expecting increases year on year. What we note on top of that, a bit of a nuisance now, is that their margins have also gone down to 12.8%. As we always say on this channel, we want increasing revenues as well as increasing margins. We also note their non-GAAP EPS down 7% year on year. What they do point out here is that their global store count is up 6% year on year. Whilst it may be good to have increasing stores of Starbucks year on year, you also need the foot traffic to come in to increase their top line, which we in fact see is down 1%, as well as those margins, which are also down. What they have, however, said is they are launching a lot of new products, which they do hope over the next few quarters, especially come summer, will help propel their top line revenue. And we can also see here that their revenue from their digital mobile order has also increased, something that they are looking forward to see the effect over the next few quarters. In terms of their guidance, now this is something that is really interesting. On their revenue, do not be expecting any double digits. They're anticipating low single digits. They're anticipating their margins to remain flat. Not that great, but again, this is what the information we have here with this company. Full-year earnings per share on both a GAAP and a non-GAAP, flat to low single digits. And in terms of total for the year 2024, global, they're anticipating low single-digit decline to flat. The same to be said for the US, and in terms of China, whilst in the quarter it was down negative 11%, for the total year 2024 single-digit decline. Now, yes, it isn't something we want to see, but they have talked about how their new store growth is looking very, very large, 6% global, 4% in the US, China double digits. What they will need to do now with China as well, which is down 11% just over the quarter, is to increase a lot of that traffic, a lot of their revenues, given they are increasing the number of stores, but unfortunately the sales just aren't coming in yet. What this has meant though, as we can see over the last year, the share price has taken a tumble. In fact, just year to date, down 19%, but what we're looking for today is to see whether or not this has created some very strong value for shareholders to take advantage of this massive drop. So let's keep moving on then. In terms of the revenue growth year on year, as always, a minimum 3 to 7%. What we do note, it has more than doubled, 16.5 billion in 2014. We noticed their latest annual report around 36 billion. So we can see very strong revenue growth. It has been increasing over the longer term. It is just something to be aware of, that for the next year they are anticipating very small single digit growth. In fact, potentially decline to that top line revenue. Over the last 10 years, how has their bottom line been? We've seen their top line more than double. We also noticed their bottom line pretty much doubled, 2.1 billion in 2014, 4.1 billion in October 2023. So over the longer term, we also note revenues and bottom line increasing. We do see some inconsistencies. Granted, we note 2020, both top line and bottom line are justifiable for those drops due to the pandemic where their stores weren't open. People weren't able to get their lattes, their bubble teas, or whatever it is they get from Starbucks. In terms of the health of the company, now this is important, especially with their yield increasing quite high in comparison to their 5-year average. Total cash in short-term investments, 1.8 billion in 2014, 3.1 billion just from that quarter that has gone. So it is an increase, but we also note their cash has been relatively higher over the last few years. It is very inconsistent as well. Nonetheless, it does sit at a higher position than it did in 2014. Now, in isolation, it doesn't really mean much, this cash position. We need to compare it to their total debt numerically and directionally, so we do understand a bit more about the company. And we notice their total debt has skyrocketed, 2.048 billion, and we do note 25.2 billion in that latest quarterly report. And as we can see graphically, their total debt has increased very, very rapidly over the last 10 years, although we do note over the last 4 years it has remained fairly flat. But this is very important, something that will be looked at when we see that borderline safe and understand if there are any issues with them being able to pay their dividend year on year, quarter on quarter. So let's take a look at their earnings historically and forward looking. What we do note is over the last 4 quarters, they have a 50% track record. They beat in Q3 and Q4 of 2023. But unfortunately, the last 2 quarters, they did miss on their earnings per share, notably the last quarter by 12 cents. Forward looking though, the anticipation is for the next quarter, it is going to be negative 6% on a year-on-year comparative. Quarter after that to end 2024, a very, very small increase year on year. The next 2 quarters, so Q1, Q2 of 2025, they are anticipating those earnings per shares to start increasing, which is where we could potentially see some very strong value. Now, if they are anticipating 358 earnings per share for the full year September 24, then the forward P currently sits at 21.72. If they do hit that earnings estimate in 2025 of 413, then the forward P of around 18.84, which could look fairly cheap now considering the S&P does sit at around 22 on average. So this is just interesting to note. We then move on to essentially some grades updated numbers. We can see a D+ on the valuation. Now, this is made up of a number of different valuation methods for Starbucks. The one we will draw your attention to, the P on a non-GAAP basis, 21.72, with others in the sector a significantly lower 15.9. So you're paying, in terms of the sector, a premium for Starbucks of 36.62%. Although do bear in mind, this is pretty much, as we said, near enough the S&P currently. The other metrics we do see fairly expensive as well, depending on what you look at. We see a mixture of C and as well as D grades. If you are someone who does look at it on a price to cash flow forward basis, 16.67, as we can see, sector median just below 10. So again, you are paying a premium of over 67%. Now, just remember, you can use these into your investment thesis depending on how you value stock. We then move on to the growth grade, a B-, pretty much consistently B across the board. Revenue year-on-year growth, 7.45%. Sector median, 2.25, so that is much better. Now, forward-looking, it does say 7.52, although we did just look at their latest earnings where they do anticipate single digit, so it should be probably around the sector median, if not slightly lower. And then the other ones that we do want to draw your attention to, the main one being the earnings per share, anticipating 12.9% increase over the next 5 years, a year-on-year increase, marginally higher than the sector median of 11.66, as we can see a bit of a discount around 10.4%. When we then draw your attention to the profitability grade, one thing that I do quite like to look at are those bottom line margins. They get an A+, so the best score obtainable. 27.74 on the gross profit, with the sector at 36.8, so they do come in fairly under. Bottom line margin though, a lot better. Always like to look at the net income margin, 11.4 with the sector at 4.7, as we can see, significantly better. And cash from operations, a significant amount, 6.54 billion versus the sector around 288 million. Now, just a quick recap for this section of Starbucks. There's a buy rating from Wall Street, a hold from Seeking Alpha, a hold from Quant. When we look at the valuation, they did get a D+, remember, comparing to others in the sector on a median basis. Growth B- with profitability sitting at an A+. Now, before we move on to the next section, just to take a look at how they've performed against others in the restaurant industry, We have Chipotle Mexican Grill, as well as a few others that we have also reviewed in detail on the channel. Starbucks, now over the last year, it is negative 25%, the worst performing. Do bear in mind, this also includes reinvesting those dividends. We do see a lot of very strong performers across the board. When we extend this over the last 5 years, it is positive, up around 9.4%, but not something you really want from any investment if you've been reinvesting those dividends, especially over a 5-year period. Over the last 10 years, substantially better, but it again depends on when you did invest in this company, up 161%. Remember though, past performance, whether it's very strong like CMG or whether it's fairly poor as we can see as Dash, it doesn't essentially mean anything. It isn't an indicator of future performance, but it is just one level or one review that we do as part of a company. So let's move on then. We do want to note insider ownership. It does sit around 2%, and we do note 3 instances of insider selling, one very recent as well. Total amount 1.53 million, and this is over the last year. So as we can see here, Q2 300,000 sold, so very recent of 2024, 376,000 in Q1 of 2024, and we see again another sizable amount in Q4, 784,000. Now, who these investors are? Well, the first thing that we do want to point out, the more recent one, we have the EVP, Sarah Kelly, on the 22nd of April. We also have the CEO, who sold on the 15th of April, quite a sizable amount, over 3,000 shares, $85, so significantly higher than the current trading price, around $77, from $277,000. Now again, the majority that we do see here are pretty much all sales by US Congress member, which we don't really discuss. So again, what we would say is it isn't necessarily a bearish signal if insiders sell. We don't know why they sell, personal or financial reasons. In fact, most of the time that we do review this, a lot of insiders do sell at a price lower than what it currently is at. But again, whether or not the information is there for you to include it into your own investment thesis. We then look at institutional ownership, 72%. We see 7.6 billion worth of sales by the institutions over the last 12 months. A lot more buying, more than 3 times over the same period. On top of that, what we also see is a lot more buying in Q1, 2.16 billion versus 923 million who sold. So again, not just over the last year has there been a significant amount of buying, but also over the more recent period. Again, something just to understand, but always do your own due diligence. Now, before we jump into the dividend safety, a quick message to let you know we have released our latest free weekly article. We run through 20 undervalued dividend stocks for the portfolio to consider. If you want access to this or any others, all completely free, do click on that pinned comment below where you can start reading. What we would say is this article here, a lot of people ask, what are the website resources that you use? It is all explained here, so you can also use them and follow along. So very important to understand, the dividend safety score is 60, borderline safe. It did get downgraded, as we will shortly see. Market cap 88 billion. It is a large cap company. So as we can see here, they were downgraded on the 1st of May. So in fact, we're just talking just over 2 weeks ago. And as we can see, what this essentially means is that there is a moderate risk of a dividend cut over a full economic cycle. And something we will do is review their next quarterly report, as that will be very important to understand whether or not they can continue to pay this dividend, as we will look at the other metrics shortly as well. Last recession, 07-09 crash, they didn't pay a dividend, so no comparative data. They had above average growth, although marginally, negative 6% with the S&P around negative 12. They also significantly underperformed the S&P, negative 69 with the S&P bringing in negative 55. Now, dividend growth, pretty decent last September, 7.5%, above the 4% inflationary rate we advocate on the channel. Last 5 years, double digit. Last 10 years, double digit. So very strong, but it will be interesting to see if this September they can continue with this, if their top line revenues are falling as well as those margins. In terms of the dividend streak, well, 13 years of consecutive increases. And in terms of looking at dividend yield theory, remember it does state a company is undervalued when the current yield sits above the 5-year average. 2.93 versus 2.05, so we have that signal of undervaluation. Likewise on the forward PE, 20.7 below the 5-year of 29. But as always, remember we're not looking at any of these models in isolation, and we will conclude towards the end. We also note the consumer discretionary does sit on a sector basis much lower at 13.5. So in terms of the payout ratios, important to understand that we don't look at the earnings as it is susceptible to manipulation by management through accounting. does help us spot dividend cuts by looking at the free cash flow payout. And my personal preference, below 60%, does give me faith that management can offer those double-digit increases we love to see. Below 50% if you do want to be industry-specific for restaurants. 2022, very high, 90%. Nice to note that 2023 it is down to 67%. 2024 anticipated 71%. What I would say, given it is slightly higher than we would like, not just our own 60%, but above the industry norm, what we would say is potential that the dividend increase this September may not be as high as 7.5, hopefully at a minimum at that 4% inflationary target. Free cash flow per share, always look at companies that increase their free cash flows over the longer term. We know with SBUX, they have increased it, although very inconsistently. We see highs of 720 in 2018. Since then, it has come down. 2023 anticipation that free cash flow is expected to be fairly flat. Although when we do look at the sales growth, remember we were looking at 3 to 7% increase year on year. Pretty much nearly every year, double-digit growth. The last 3 years, very, very strong. We have the COVID year of 2020. The only thing we would say is 2024, the anticipation is very low single-digit increases. In terms of total sales then, numerically, this is something we've already covered, but just a different format. What they have done, although not very regularly, is return that excess cash through those share buybacks, reducing it from 1.53 billion to 1.14 in the latest quarter. So always nice to note they do give you a greater portion of that company as they do start buying back those shares. No mention of it though in that latest investor presentation moving forwards. ROIC, very important to understand management, their ability to effectively allocate their capital. Above 12% for restaurants, for me above 10%. Last 3 years very strong, 12 months at 33% as well. So it is looking good, very attractive to investors, or in fact potential investors who are looking to add this undervalued company. Operating margin above 16% for restaurants. SBUX, I mean, pretty much straddles around that every single year, so consistent with that regards. But again, just something we can keep our eyes on, especially since that latest quarter, they were talking about how it is anticipated to drop or at a minimum be flat. In terms of free cash flow then, above 5% for restaurants. They have again pretty much straddled around that fairly strongly, in fact, over the last 3 years. Something that we will keep our eye on given the fact that with these numbers they have reported it could impact these margins. Net debt to EBITDA then, the earnings before interest, tax, depreciation, amortization, below 3.5 for restaurants. Remember, these are the number of years it would take the company to pay off their debt net of cash on hand. And these numbers ultimately correlate to both dividend safety as well as balance sheet strength. 2.06 in 2023, 2.11 anticipated in 2024. So it does look safe for now. Granted that when we look at the free cash flow payout, it is at 72%, which is higher than the 50% that is expected for the industry. Overall, though, so far does look good. We will obviously continue to analyze this quarter and quarter as well as the annual reports that are provided. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model that we're taking a look at today, the multiples valuation model. Companies in a similar sector and size that we reviewed earlier, their P multiple, the average, multiplied by the EPS of SBUX to get an intrinsic value of $123. We have an undervaluation signal. Just bear in mind we don't look at any of these models in isolation. We then move on to the dividend discount model. We have the growth in the dividend year on year looking very strong, 9.65%. Forward looking though, we have tried to be a lot more conservative, below the average as well as below the more recent increase. This does give an intrinsic value of around $96. Again, we do have another undervaluation signal, so 2 for 2. When we look at the third model, the DCF, discounted cash flow model, we have the free cash flow year on year. Average growth rate, very, very high. We in fact note just the last year was 48%. Forward looking, this is over the longer term, so we do believe they will continue to increase it. We have gone for 11%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And as we can see here, another undervaluation signal. So in today's episode for SBUX, we have a triple undervaluation signal. Now the intrinsic value here is just the average of these three models. In today's episode coming to $105. And as always, you can click on the pinned comment below to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list. Margin of safety then, important to understand. We only execute on a 10% MOS level if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Starbucks, then it is a buy up to $95, and then we keep going till it's near the current trading price to see what Starbucks is currently trading at. And in today's episode, we do see it pretty much at a 25% MOS level. Now, different investors will decide whether or not that is sufficient for them. Don't forget, it does have a yield of just nearly touching 3%, and it does look to be safe based on the information that we have gone through in today's episode. In terms of Wall Street, they see upside of 18%. Now, this is one that as the share price did drop, that they ultimately revised their price targets downwards. But I do envisage over the next few months, Wall Street will in fact start to increase their price forecast as the share price does start to rebound from those 52-week lows we saw not too long ago. So in conclusion for today's episode, 25% MOS, upside of 18% for Wall Street over the next year. And this is also one that I have been adding to the portfolio. I did a video not too long ago talking about those stocks that I have been adding, and this is one that I have added over the last few weeks as well. As always though, do let me know your thoughts in the comments below. Is Starbucks one you're looking to add? Maybe one you're looking to just hold, or maybe it's on your watch list. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. As always, let us know your thoughts, and we'll see you all on the next one.